Hi, it's Carl with Personal Pension Solutions, and today we're going to look at a safe and liquid idea that maximizes your lazy money. So here's the problem. A lot of people have some money sitting around in low-paying accounts. They don't want it in the stock market because the stock market is crazy, but the bank isn't paying them any interest. So what else is there? And here's their conditions of satisfaction. It must be safe, they need a chance to earn better returns, and they must be able to cancel it and get out of it whenever they want in case something better comes along. So let's look at an example. Here's a 65-year-old female. She has $50,000 laying around. She wants access to it in case she needs it. And if she doesn't spend it, it's just going to pass on to the kids and grandkids. So she's open to ideas on how to safely maximize that money because it's barely earning any interest. So let's look at an illustration. If you get an illustration run on your situation, it's 10 pages. So I'm going to walk you through some of the key numbers. If you have $50,000 sitting in your checking account and you pass away, your family gets $50,000. In this account, for our 65-year-old female, if she passes away in a day or a week or a year, it blossoms to a death benefit of $91,000 income tax free to the family. So she's maximized that portion of it. What would happen if she passed away? $50,000 turns into $91,000 if she happens to pass away. Then down on page 6, there's also long-term care benefits. If you have $50,000 in your checking account or a savings account and you get sick or need long-term care, there's $50,000 to pay for it. In this, she's able to access that $91,000 in the form of a monthly benefit. If she needs nursing home care, it gets paid out over 3 years. If she has chronic care, it gets paid out over 5 years or 60 months. So the nursing home benefit would be $2,520 a month for 3 years. That comes to over $90,000. And the chronic care benefit will be $1,512 a month for 5 years. Again, that's over $90,000. So she's maximized the amount that she would have in case she gets sick and needs long-term care. Then down on page 8, I'm showing you the fixed bucket illustration here. I'll show you the index bucket in a second. But here is the guaranteed values, okay? This assumes the highest cost of insurance and the lowest guaranteed interest rate. We're not at that point, so your numbers would be better than this right off the bat, but worst case scenario, this is what you get. You can see on the cash surrender side, if you don't like this thing after a week, you could get your 50 grand back in a week or a year or 5 years or 10 years. That's your worst case scenario, is you get your 50,000 back whenever you want. And you can see here's the death benefit. It starts a little bit higher than 91,000, and then it decreases, and then your minimum is 91,000. On the non-guaranteed side, I'm showing you the fixed bucket. These are assuming current fixed interest rates, okay? You're not linked to the market. You're not invested in the market. These are just fixed rates. You can see that your cash surrender value is growing. So let's say you're in this thing for 3 years, and your cash surrender value is $52,370. That's over a 1.5% return on a fixed basis, which is more than what the bank's paying right now. And you could, let's say bank rates go up, you could take that 370 and put it in the bank or put it in the market. Or let's say you want a new car or you need house repairs. Whatever you need, you get back your 52,370. If you wait, let's say it's in 4 years, you get back 53,123. So at any time, you get back whatever your cash surrender value is. Worst case is 50,000, but if there's some interest, you get back that plus some interest, which is competitive or a little bit higher than what the bank's paying right now. And you can see here, assuming a little bit higher interest rate in the fixed bucket, your death benefit's going to start a little higher as well. So that's what it looks like on the fixed side. Now let's take a look at the index side. Instead of being in the fixed account, you could be in the indexed account, and that works just like an indexed annuity. So for those of you not familiar with it, here the red line is the S&P 500. In an indexed annuity or an indexed life insurance, in a year the market goes up, you get some of the gains, and then in a year the market goes down, you don't lose anything. So this gives you a chance to earn more interest than you could in a fixed account without having to have your money at risk. So how would that look in this illustration? Well, you can see no matter if you go at the fixed side or the index side, you're going to start at the same levels. You put in $50,000, next week it's worth $91,000 in a tax-free death benefit to your family. So you still blossom it there. And if we go down to page 6, the long-term care benefits are exactly the same as well. The difference comes in the cash accumulation account. You can see on the guaranteed side, it's still, $50,000. You don't like it after a week, you get your 50 grand back. But since you're indexing now, we have the chance to earn more interest than we could on the fixed side. So you can see, let's say you're in this thing for 3 years and your cash surrender value is worth $54,806. That's a 3% return without having your money at risk. And you could call them up and say, hey, I need a new car, or I want to move it into a bank, or I want to move it in the market. Whatever you want to do with it, you get your 54,806 back after 3 years. If it's 4 years, according to this illustration, you're at 56,484. That's what you get back. So you can stay in this thing as long as you want, or if you want your money, you can take it back. And again, your worst case is getting back 50,000. You can also see on the index side, we start with a little bit higher death benefit as well. So that's how the index side works. So what is it? Well, it's a single premium life insurance policy. It has a death benefit, there's a return of premium guarantee, it has long-term care benefits, and an interest earning account. And again, the key thing is you can get your money back plus that interest whenever you want. What's the catch? Well, you cannot use IRA or 401k money. It has to be non-qualified money only. There's a $10,000 minimum, and there are some basic underwriting questions. So I'd say get an illustration based on your age and your situation. See what your numbers would be. The younger you are, the higher your numbers. The older you are, the lower your numbers. And there's two ways to get an illustration. One, you can call me at 847-376-8400, or just click on the link below, enter your information. We'll email it to you so you can see what it would look like for you. And again, remember, you can get back your money whenever you want. Have a great day.